Disclaimer.
December 29th, 2024. Silver traders around the world watched their screens in disbelief as the metal touched $82 per ounce, an all-time record high that shattered every previous peak in history. Then, in less than 6 hours, the entire rally evaporated. A 9% freefall to $72, the steepest single-session collapse in 5 years, left millions of investors frozen between two terrifying choices. Panic, sell everything, or double down on what might be the buying opportunity of the decade. Before continuing, let me thank you. More and more of you are following my news, and I appreciate your trust. Don't forget to subscribe and like so you don't miss my next videos. Here's what makes this moment different from every other silver crash you've seen. This isn't just another technical correction or profit-taking event. Something fundamental shifted in the global silver market on that exact day, and most investors still have no idea what actually happened behind the scenes. Let me paint you a picture of the chaos. Futures traders who bought contracts at $78 watched $7,000 per contract vanish in a single afternoon. Retirement accounts holding silver ETFs dropped 9% before lunch on the West Coast. Physical dealers reported unprecedented phone volume as panicked sellers tried to liquidate coins and bars, while simultaneously a different group of buyers placed the largest bulk orders they'd seen in years. You know that feeling when you're watching a fight and both boxers throw knockout punches at the exact same moment? That's exactly what happened in the silver market. While Western investors were hitting the sell button in pure panic mode, institutional buyers on the other side of the world were quietly accumulating massive positions at $70. And then China made an announcement that changed everything. On the same day as the crash, Chinese authorities revealed new export licensing restrictions for refined silver effective January 1st, 2026. Now, if you're thinking that's over a year away, so why does it matter right now? You're missing the whole game. According to official Chinese customs data, their refineries control somewhere between 60 and 70% of the world's refined silver supply. That's not an exaggeration. That's the actual physical metal that goes into solar panels, electronics, medical devices, and every industrial application you can imagine. Here's where it gets interesting. Within 72 hours of that announcement, Shanghai silver premiums spiked to $5 above US spot prices. Think about what that means for a second. Chinese buyers are willing to pay $5 extra per ounce compared to what Americans pay, just to secure physical delivery right now. That kind of premium spread hasn't appeared since the supply shortages of 2020, and back then it signaled the beginning of a massive rally. But we need to zoom out and understand the real battlefield here. The $70 to $75 zone is not just some random price level where the market happened to find temporary support. This specific range represents a mathematical convergence point where multiple powerful forces are colliding all at once. First, we have 5 consecutive years of global supply deficits creating a structural shortage that's only getting worse. The Silver Institute's latest World Silver Survey shows that global demand reached 1.24 billion ounces in 2025, while total supply, mining, recycling, everything combined, produced only 1.01 billion ounces. That's a 230 million ounce deficit that has to come from somewhere. Existing stockpiles and inventories have been quietly draining year after year, and we're approaching a point where the cupboard might actually be bare. Second, industrial buyers are front-running the China restrictions by locking in supply contracts right now, a full year before the licensing requirements even take effect. Major manufacturers learned their lesson from the rare earth crisis, when China imposed similar export controls, and companies that did not secure supply early enough faced complete production shutdowns. Ford had to suspend an entire U.S. factory line for 3 months because they couldn't source enough neodymium for electric motors. No executive wants to explain to shareholders why their production line stopped, because they failed to anticipate a known supply restriction. Third, algorithmic trading systems have identified $70 as a key technical support level based on years of historical price data. These are not human traders making emotional decisions. These are quantitative models managing billions of dollars that automatically trigger buy orders when price touches specific zones. The moment silver dipped toward 70, algorithmic buy programs activated across multiple exchanges simultaneously, creating a floor of automated buying pressure. So you've got physical shortage, industrial panic buying, and algorithmic support all converging at the same price level. What happens next determines everything. According to commodities analysts at Bank of America, if silver consolidates above $70 for just 10 trading days, the probability of a move toward $100 within 6 months increases to above 70% based on historical pattern recognition. But here's the terrifying flip side that nobody wants to talk about. If that $70 floor breaks, if it fails to hold under sustained selling pressure, the entire bull market thesis collapses. We're talking about a potential cascade down to $55, or even lower as momentum traders bail out and stop losses trigger in waves. This is the binary moment. Either we're witnessing the pause before the next explosive leg higher, or we're watching the top of a false breakout that's about to reverse with devastating speed. The crash from 82 to 72 wasn't random volatility. It was the market's immune system responding to China's export announcement. Algorithmic systems instantly recalculated supply probabilities, high-frequency traders liquidated overbought positions, and paper-silver contracts got hammered while physical premiums simultaneously exploded higher. The divergence between paper price and physical availability is starting to mirror what we saw in gold during March 2020, when premiums went ballistic and dealers simply ran out of inventory. Shanghai premiums tell us everything we need to know about actual physical demand. When Chinese buyers pay $5 per ounce above Western prices, they're signaling that metal is harder to find than the spot price suggests. Those premiums don't appear because traders feel optimistic. They appear because industrial buyers need physical silver for production lines that can't stop, and they're willing to pay whatever it takes to secure supply before the licensing restrictions make it exponentially more difficult. You need to understand what's really at stake here. The next 72 hours will determine whether $70 holds as legitimate support or collapses as a false floor. If institutional buyers continue accumulating at these levels, if physical premiums keep expanding, if volume confirms strong hands are buying the dip, then we're looking at a setup similar to early 2020, when silver bottomed at $12 and subsequently rallied to $30 within months. But if selling pressure overwhelms the $70 zone, if we see sustained breaks below 68 with high volume, the entire narrative changes. What looked like a healthy correction transforms into the first warning sign of a major top. And traders who bought the dip at 75 or 70 will face serious losses as the market searches for a lower equilibrium. The question isn't whether silver is a good long-term investment. The question is whether right now, at this exact moment, $70 represents a gift or a trap. And to answer that question, we need to look at exactly how China's export restrictions actually work, and what the real supply deficit numbers tell us, and whether the technical chart patterns confirm institutional accumulation or distribution. Because if 70 breaks, your portfolio is about to experience pain. But if it holds, we might be witnessing the setup for the most explosive silver rally in over a decade. The clock is ticking. Let's talk about what China's export licensing framework actually means in practice, because the details reveal why this is not just another bureaucratic policy change. This is a deliberate restructuring of global silver supply chains that will force every major manufacturer to completely rethink how they source this critical metal. The new regulations require any Chinese company exporting refined silver to demonstrate annual production capacity exceeding 80 tons, maintain specific financing thresholds that smaller operations simply cannot meet, and navigate a licensing approval process that typically takes 6 to 9 months. According to commodity trade analysts at Refinitiv, these requirements will immediately eliminate hundreds of smaller Chinese exporters who've been supplying Western markets for decades. Think about the math here for a second. China has roughly 300 active silver refineries and trading companies that currently export to global markets. Based on production data from the China Non-Ferrous Metals Industry Association, approximately 200 of these operations produce less than 80 tons annually. Overnight, 2/3 of Chinese silver exporters lose their ability to sell internationally. Where does that metal go? It stays in China for domestic use, or it gets routed through the handful of massive state-affiliated refineries that meet the new requirements and can charge whatever premium they want. Now, you might be thinking this sounds familiar, and you'd be absolutely right. China deployed the exact same playbook with rare earth elements starting in 2010. They implemented export quotas and licensing requirements that consolidated control among a few large state-connected firms. And within 18 months, rare earth exports dropped by 59% while prices skyrocketed. Global manufacturers who didn't secure long-term contracts before the restrictions hit faced catastrophic supply shortages. Here's a real example that should grab our attention. Ford Motor Company operates a factory in Michigan producing electric vehicle motors that require neodymium and dysprosium, both rare earth elements controlled by Chinese export licensing. In 2011, when China tightened rare earth exports, Ford couldn't source enough material to maintain production schedules. They suspended an entire assembly line for 3 months, laid off workers, and eventually paid triple the previous price to secure emergency supply through alternative channels. The total cost of Ford's bottom line exceeded $200 million for a supply disruption they could have prevented by locking in contracts 12 months earlier. Every automotive executive, every solar panel manufacturer, every electronics company watched that disaster unfold. Nobody wants to be the next cautionary tale, explaining to shareholders why production stopped because they failed to anticipate a clearly telegraphed supply restriction. That's why we're seeing industrial silver buyers moving right now, a full year before China's licensing requirements take effect. They're not waiting to see what happens. They're securing multi-year supply contracts at today's prices before premiums explode. And the supply deficit numbers back up this urgency with mathematical precision. The Silver Institute's World Silver Survey, which aggregates data from mining operations, refineries, and industrial users worldwide, shows that 2025 demand reached 1.24 billion ounces, while supply totaled only 1.01 billion ounces. That's a 230 million ounce structural deficit in a single year. But here's what makes this deficit fundamentally different from past shortages. In previous cycles, when silver demand spiked temporarily, mining companies could ramp up production within 18 to 24 months by opening new deposits or expanding existing operations. This time, the deficit is not driven by a temporary demand spike. It's driven by permanent structural changes in how the global economy uses silver. Solar panel manufacturing alone has tripled its share of total silver consumption from 5% in 2019 to 15% in 2025, according to the Solar Energy Industries Association. Every megawatt of solar capacity requires approximately 20 ounces of silver for photovoltaic cells, and global solar installations are accelerating, not slowing down. The International Energy Agency projects solar deployment will double again by 2030 as countries push toward carbon reduction targets. Then you layer in data center build-out consuming massive amounts of silver for electrical contacts and thermal management systems. Microsoft, Amazon, and Google are collectively spending over $100 billion annually on data center infrastructure to support AI computing, and every server rack contains silver-plated components that ensure reliable electrical connections under extreme processing loads. Electric vehicle manufacturers add another layer of structural demand. Tesla alone used an estimated 4 million ounces of silver in 2024 production across battery contacts, charging systems, and electronic controls. Elon Musk publicly warned on Twitter in November that battery-grade silver supply constraints represent a legitimate bottleneck for EV scaling. And Tesla's procurement team has been aggressively locking in forward contracts to secure supply through 2030. So we're not talking about speculative investment demand that can evaporate when sentiment shifts. We're talking about industrial consumption that's baked into multi-billion-dollar infrastructure projects already under construction. These solar farms, data centers, and EV factories are getting built whether silver costs $70 or $100 per ounce, because the alternative is abandoning projects with sunk costs in the billions. Mining supply can't respond fast enough to this structural demand shift. According to S&P Global Market Intelligence, it takes 7 to 10 years on average to bring a new silver mine from discovery through permitting, construction, and first production. Even existing mines seeing it significantly increase output without major capital investment and environmental approvals that take years to secure. The supply side is essentially frozen at current levels for the foreseeable future, while demand accelerates every quarter. Let's get into the technical analysis, because the charts are telling us something really important about what's happening beneath the surface noise. The $70 to $72 zone is not just psychological support. It represents a mathematically significant price level that has been validated multiple times across different time frames and technical frameworks. First, look at the Fibonacci retracement levels from silver's November rally. The metal bottomed around $58 in early November before launching toward the $82 high. When you draw Fibonacci retracement levels from that swing low to the recent high, the 23.6% retracement lands almost exactly at $71. This is not numerology or fortune telling. Fibonacci levels work because institutional algorithms use them as reference points for placing orders, creating self-fulfilling support and resistance zones. Second, the volume profile analysis reveals something fascinating. When you look at total trading volume distributed across different price levels over the past 6 months, you see massive accumulation clusters right in the $70 to $75 range. This tells us that huge amounts of metal changed hands in this zone during the late 2024 consolidation period before the final breakout to 82. Large institutional positions were established at these levels, and those holders have zero incentive to let price break meaningfully below their average entry point. Third, and this is the detail that really matters, look at the candlestick pattern that formed on the exact day of the crash. After falling from 82 to a low of $70 intraday, silver closed the session at $72, creating what technical analysts call a hammer candlestick. Long lower wick, small body near the top of the range, signaling that aggressive buyers stepped in at 70 and drove price back up by the close. But the real confirmation came from the volume. According to CME futures data, that session saw 180 million ounces of silver contracts traded, nearly triple the 90-day average volume. Massive volume on a hammer reversal pattern at a key Fibonacci level is textbook accumulation, not distribution. Big money was buying, not selling, and they were buying specifically in the 70 to 72 range. Here's how you know institutional buyers are positioning for higher prices rather than bailing out. Look at the options market. Open interest in call options for strikes between $85 and $100 has increased by 40% since the crash, according to Options Clearing Corporation data. Somebody is betting serious money that silver moves significantly higher within the next 3 to 6 months, and they're placing those bets right after the crash, not before it. The Shanghai Premium gives us real-time confirmation that physical demand is overwhelming paper price discovery. When Chinese buyers pay $5 per ounce above Western spot prices, they're telling us the actual availability of deliverable metal is much tighter than futures trading suggests. These premiums do not appear because of currency fluctuations or shipping costs. They appear because metal is genuinely difficult to source in the physical market, and industrial buyers need it regardless of price. Historically, sustained Shanghai premiums above $3 have preceded major silver rallies every single time. In March 2020, Shanghai premiums spiked to $8 as COVID disrupted supply chains, and silver subsequently rallied from $12 to $30 within 5 months. In early 2016, premiums expanded to $6 during supply concerns, and silver rallied from $14 to $21 over the next quarter. The pattern is consistent. Physical shortage drives premiums. Premiums force paper market repricing. Paper market repricing triggers momentum buying, and momentum buying creates explosive rallies. We're watching the early stages of that sequence play out right now, and the $70 level is where it either confirms or fails. Everything comes down to whether buying pressure can absorb selling pressure at this specific price level over the next several trading sessions. If it holds, if we see continued high volume with prices stabilizing between 70 and 75, then the crash was just a violent reset before the next leg higher. But if sustained selling breaks through 70 with conviction, the entire bullish structure comes into question, and we're looking at a potential retest of $60 or lower. The evidence is overwhelming that structural forces favor significantly higher silver prices over time. China's export restrictions will reduce available supply, industrial demand continues accelerating, supply deficits are real and growing, and technical indicators suggest major institutional accumulation. The only question is timing. Does the rally resume from $70 right now, or does the market need to find a lower equilibrium first before the next move? We're about to find out which scenario plays out. Here's the binary calculation that determines everything. If silver holds above $70 through January 10th, 2025, that's 10 consecutive trading days of consolidation without breaking lower, algorithmic trading systems will interpret this as confirmed support, and buy triggers will activate across multiple quantitative funds simultaneously. Let me break down exactly how these algorithmic triggers work, because understanding this mechanism is critical to predicting what happens next. Quantitative hedge funds managing hundreds of billions in assets use momentum and breakout strategies that rely on statistical pattern recognition. When a price level holds under selling pressure for a specific number of days while volume remains elevated, these models classify it as validated support rather than temporary pause. The magic number is typically 8 to 12 trading days, depending on the specific algorithm's parameters. We're currently on day 3 since the crash. If we reach day 10 with silver still trading between $70 and $75, those quantitative models will shift from neutral positioning to aggressive long positioning, placing enormous buy orders that push price toward the next resistance levels at $85 to $90. Think about the firepower we're talking about here. Renaissance Technologies, 2 Sigma, Citadel, and dozens of other quant funds collectively manage over $300 billion in commodities-linked strategies. When their algorithms flip from sell mode to buy mode simultaneously, they can move entire markets in a matter of hours. According to Bloomberg data, algorithmic trading now accounts for roughly 65% of total futures volume in precious metals. These aren't minor players, they are the market. So if 70 holds for 10 days, we're looking at a potential move to $85 to $90 by mid-February, driven purely by algorithmic momentum, before we even factor in physical demand dynamics. But here's the devastating flip side that keeps traders awake at night. If price breaks below $68 with strong volume, those same algorithms interpret it as failed support and sell triggers activate instead. A confirmed break below 68 invalidates the entire bull market structure from a technical perspective. The November low at $58 immediately comes into play as the next support level, and if that breaks, we're looking at a cascade toward $55 or potentially lower as stop losses trigger in waves, and momentum traders bail out of positions. This is the nature of algorithmic markets. They're binary. Either support holds and buying pressure accelerates, or support fails and selling pressure accelerates. There's no middle ground, no gradual drift. We're at the inflection point where the next move will be fast and violent in one direction or the other. But let's zoom out from the immediate technical picture and look at the bigger strategic calculation that major institutions are making right now. January 1st, 2026 is exactly 1 year away. That's when China's export licensing restrictions officially take effect. This creates a ticking clock that fundamentally changes the risk calculation for every industrial buyer who depends on silver supply. If you're a procurement manager at a solar panel manufacturer, you're looking at this timeline and doing some very uncomfortable math. You need to secure enough silver to maintain production for at least 12 to 18 months, because once those licensing restrictions hit, availability becomes completely unpredictable. You don't know which Chinese exporters will successfully obtain licenses, how long the approval process will actually take, or what premiums will look like in a restricted market. The rational move is to lock in supply now at $70 to $75 per ounce, even if that feels expensive compared to historical averages, because the alternative is potentially having no supply available at any price this time next year. According to supply chain consultants at McKinsey, industrial buyers are willing to pay a 20 to 30% premium over current spot prices to secure guaranteed multi-year delivery contracts that protect against future supply disruption. That buying pressure isn't speculative, it's existential. These companies have billion-dollar production facilities, thousands of employees, and contractual obligations to deliver finished products to customers. They cannot afford to let silver availability become the bottleneck that shuts down operations, so they're securing supply regardless of short-term price moves. Now layer in what the major investment banks are telling their clients. Goldman Sachs recently shifted their recommended portfolio allocation from the traditional 60-20-20 split, 60% stocks, 20% bonds, 20% gold, to a new framework that includes silver as a distinct allocation category. Their updated recommendation suggests 60% stocks, 10% bonds, 15% gold, and 15% combined silver and other precious metals. Think about what that means in dollar terms. If institutional portfolios globally shift just 5% of their bond allocation into silver, we're talking about hundreds of billions of dollars of buying pressure hitting a market where total annual supply is only worth about $70 billion at current prices. The available supply simply cannot absorb that level of institutional demand without massive price appreciation. Goldman's target price for silver by 2027 is $150 per ounce, based on their modeling of supply constraints, industrial demand growth, and potential monetary policy shifts toward inflation. JP Morgan's commodities research team published similar projections in their fourth quarter 2024 outlook, suggesting silver could trade between $120 and $180 within 3 years if supply deficits persist. These are not fringe analysts making wild predictions on YouTube. These are the research departments at the largest investment banks in the world, advising trillions of dollars in client assets. When Goldman and JP Morgan both published triple-digit silver price targets, institutional money managers pay attention. But all of those bullish scenarios depend entirely on one critical assumption, that $70 holds as legitimate support right now. If it breaks, every projection gets thrown out, every bullish thesis gets questioned, and we're back to square one trying to figure out whether the entire rally was just a false breakout, driven by temporary momentum rather than fundamental supply-demand imbalance. This is why the next 72 hours are absolutely critical. We need to watch two specific signals that will tell us whether institutional buyers are genuinely accumulating or whether the $70 floor is an illusion about to collapse. First, daily volume needs to remain elevated above 200 million ounces in futures contracts. High volume at support indicates strong hands absorbing selling pressure. If volume drops off significantly while price chops around 70 to 72, that suggests weak conviction and increases the probability of a breakdown. According to CME data, the last time silver established a major bottom that held for months, volume remained above 150 million ounces daily for at least 2 weeks during the initial consolidation phase. Second, watch the Shanghai to London price arbitrage gap. Right now, it's sitting at $5 per ounce. Chinese buyers paying $5 extra compared to Western prices. If that gap expands to $7 or more, it signals that physical delivery failures are beginning to materialize. Historically, arbitrage gaps exceeding $7 have preceded explosive vertical rallies because they indicate the paper futures market has completely disconnected from physical reality. In 1980, when silver made its legendary run from $11 to $50 in just 4 months, Shanghai premiums, though less transparent then, were reported at $10 to $15 in the final parabolic phase. In 2011, when silver rallied from $26 to $49 in 3 months, Shanghai premiums hit $8 at the peak momentum phase. The pattern is clear. Extreme physical premiums equal imminent price explosions, as paper markets are forced to reprice toward physical reality. If we see sustained Shanghai premiums above $7, combined with volume above 200 million ounces daily, those are the signals that physical delivery failures are starting to cascade through the system. At that point, price becomes almost irrelevant because industrial buyers need the metal and will pay whatever it takes, triggering the kind of 40 to 50% vertical moves we saw in previous supply crisis events. But here's the warning you need to internalize. If those signals don't materialize, if volume fades and premiums compress back toward normal levels while price drifts lower, then the crash from 82 to 72 was not a healthy correction. It was the first warning of a major top. In that scenario, the next move is down towards 60, then 55, then potentially a full retest of the $50 lows from late 2023. You have to make a decision based on the evidence available right now. The structural fundamentals strongly favor higher silver prices over the next 12 to 24 months. China's export restrictions will reduce available supply. Industrial demand continues accelerating from solar and EVs and data centers. Supply deficits are real and growing, and major investment banks are forecasting triple-digit prices within 3 years. But market structure in the immediate term is fragile. We're balanced on a knife edge at $70, where the next move will be decisive. You cannot afford to be complacent or assume the bull market will just magically resume without validation. This is the moment where you either position based on the weight of evidence suggesting higher prices ahead, or you protect capital by waiting for clearer confirmation that support has held before committing. The crash from $82 was not random. It was the market's way of testing whether demand is strong enough to absorb profit-taking and algorithmic selling. If buyers step up and defend $70 over the next week, the answer is yes, and the next leg toward 100 plus begins. If they don't, the answer is no, and we're looking at a brutal deleveraging that takes price significantly lower before any recovery can begin. And watch those two signals. Volume above 200 million ounces daily and Shanghai premiums expanding towards $7 or higher. Those will tell you everything you need to know about whether we're at the beginning of the next explosive rally or the end of a false breakout. The setup is there, the fundamentals support it, the technical patterns suggest accumulation, but none of that matters if 70 breaks. $70 is the line. Everything depends on whether it holds.